The main Asian currencies, the Japanese yen and Chinese yuan, are both plunging, which could knock out the world's two biggest customers for America's federal debt. What's driving the plunge is that markets now expect the Fed to keep rates higher for longer, since it's taking them longer to strangle the U.S. economy than they had anticipated. The problem is both China and Japan have much lower interest rates, which drains money out of them to the U.S. to earn higher returns. In China, rates are at 3.25%, so that's about 2 points lower in the U.S. In Japan, they're actually minus 0.1%, so you would have to be a masochist. Why so low? Because they didn't have double-digit inflation, so their central banks aren't trying to kill them. If that money can earn a lot more in the U.S. at 5.25% than it can in China or, God forbid, Japan, it floods out, selling the local confetti and buying dollars. At which point those governments swing into action, selling their U.S. debt to soak up their worthless currencies. A few days ago, Japan's top foreign exchange official, Masato Kanda, issued yet another desperate plea against the rapid decline in the yen after it fell nearly 7% in the last 2 months, bringing its total fall to nearly 40% since the pandemic. This is Japanese yen, is not the Argentine peso. The Chinese yuan is not much better. A 10% fall since May has brought it near 15-year lows, prompting China to order private banks to sell their dollar assets and buy up the yuan. Now, normally both Japan and China try to keep their currencies weak so their exports stay cheap. They do that by hoarding U.S. dollars in the government. That means fewer dollars chasing yuan, which means a cheap yuan, presto, cheap exports. Those hoarded dollars are invested primarily in federal U.S. debt. That means both the yuan and the Japanese yen are perennially undervalued. The Economist magazine keeps track of this, and they estimate the yuan is undervalued by about 40%, and the yen by closer to 50%. So that's actually a problem because it's too cheap, because imports get expensive if your currency is worthless. So Japan, for example, imports close to 100% of its gasoline. If gas is selling for $4 a gallon in the rest of the world and the yen's at 100, with taxes, that's about 500 yen per gallon. But if the yen goes to 150, that jumps with taxes to about 750 yen per gallon. So that's 50%. Keep in mind, wages in Japan are about half those in the US, so that feels more like $10 gas. Of course, it gets worse when oil prices are rising. They're up 30% since June. That makes for a near doubling, which is a shock to the Japanese public, who then demand a stronger yen. So what is next? US data is telling the Fed to keep it up. China is actually cutting rates to fight off a financial collapse, and Japan has got miles to go before 5.25%. So expect more investors fleeing both China and Japan, delaying the fallout of de-dollarization, but also draining Treasury of its two best customers, China and Japan. And that could push the Fed to stop its quantitative tightening policy of selling U.S. debt to fight inflation, instead returning it to those halcyon pandemic days, buying treasuries hand over fist and driving inflation back towards double digits. Okay, we'll be watching. See you next time.